As we continue our focus on this equity markets rally, Jeffrey Small joins me, President, Arbor Financial. Your thoughts on a market that's basically at 3-month highs, and you have names, and I know you're going to be talking about Microsoft, Meta, and Amazon 52-week highs. What's going on here? How do you feel about the market?
Well, the market is kind of hitting a weird stage right now where we're not seeing the same growth in the market, actually. And so we've got about 61% of the S&P that's reported so far, Nicole, has exceeded expectations. That's the lowest since the first quarter of 2020, coming out of that really good long-term secular bull run from March of 09 to actually January of 2020. And so, the market is hitting a little bit of a staging malaise here. And the current market run-up really has more to do with the organic decrease in interest rates in the bond markets than it does by the actual Fed in action. And so the rate environment organically will shift. We'll probably see another 60, 70 basis point drop on rates from here, and that'll fuel another 5 to 7% growth in the market between now and the end of the year. But that has nothing to do with the market outlook for next year. That's just been the reaction of the markets all year long. As rates go up, market prices fall, and as rates go down, market prices go up. But it doesn't change the fact that you've got to own in this environment what is growing, who is growing their bottom line, their top line, while they're mastering their net profit from an engineering perspective on their balance sheets. And so that's the key from here, Nicole.
Understood. So at this point now, you're looking for somewhat of a pullback to get in and buy the market, but you do see upside. You said 5 to 7% growth. You have this inverse relationship. We particularly saw it with tech, right? As rates went up, stocks went down, and then the opposite would happen. We're going to be in a higher for longer environment, but you still think there's room to run on some of these names like the Magnificent Seven that are already at 52-week highs, right?
Well, of course there is, but I think, you're taking a longer-term perspective on those positions now, since they have already had their 160 to 200+% run-up since their bottom. And so I think that you got to have a longer perspective. Does it make sense to still buy those on the days that we're down and we see pullbacks or we have economic data that surprises and pushes those prices down? I think it absolutely makes sense for the average investor going forward. And, for the advisors that are out there, if this hasn't been a core part of their portfolio because the entire marketplace and all the prognosticators from the advisory business have been completely incorrect this year, while most of the market has earned 0% growth this year, we know the Magnificent Seven, like the last guest you had on, obviously was saying that that's what's carried the market this year. But there are a few other stocks that have done okay besides the Magnificent Seven, too. They don't have the complete franchise. So let's say maybe 85% of the market's at zero, and about 15% of the market has had positive results. The key is knowing what to buy going forward.
So, like a Microsoft, for example, is a name that you like. It's at 369 today, hit a 52-week high, 373. Where do you think that's headed in 12 months and 18 months as you're looking longer term? Where do you think Microsoft could go?
Well, I think we see Microsoft at 450 if they keep their current earnings trajectory. And as we come off of the rate structure here over the next 12 to 18 months, we see the Fed lowering rates by midsummer next year. And when that happens, of course, that's going to buoy these stocks up even further. But, the Microsofts and the Magnificent Seven group, they've really kind of bucked the hold rate trend. And what's really fueled their growth in stock price is two things. One, they were beaten up pretty badly. But two, they've been increasing their model and improving their earnings across the board, top and bottom line. And so as they're doing that in an environment that's challenging, where the rest of the market really is kind of decompressing from an earnings perspective, we're not in that environment for broad growth across the markets. And so when a lot of folks said in August, oh, you've got to buy the rest of the market is going to catch up. I said, poppycock, that's not true at all, because their earnings don't justify that faith, other than their prices are actually lower, and they haven't really recovered since last year. That's not enough of a reason to buy the small caps and the mid caps and the rest of the market that's got left behind.
There's really a feeling that Microsoft has such a great AI position too, and that's another reason why people love it. Meta and Amazon have each hit 52-week highs as well. And for example, Meta trades around the same range. It's at 332. Do you think that could go up $75, let's say, Meta?
I do. I would be surprised if Meta's not over $400 in 12 months, and within 2 years, not over $500. I would be in shock. Over the next 24 months, I think we'll see Meta broach that $500 price target.
Wow, that's I'm writing that down. And then last but not least, what are your targets, let's say on Amazon, which is at 143 today?
Well, my 12-month price target on Amazon was around 185. That was in August, and so I would look for them to hit that mark as long as their earning trajectory keeps expanding. You know, Amazon just had one of their best quarters in history. They are growing by double digits on all components of the revenue model. And so in that environment, you really want to hold on to Amazon. I think they're going to be focusing more on revenue as they get away from the expansionary side of the business. And let's face it, it's about time Amazon improves its bottom line.
All right. I mean, how about a name like JD.com, just because, you know, it's similar business, I guess. You know, some of the Chinese stocks came in focus today. We've had Tesla in focus this week, a lot of the retailers. Any final thoughts that you want to add in here, Jeffrey Small?
Well, I think the economy is going to be hitting some challenging times here in the next 6 months. I'm not calling for any kind of a hard landing, but I think we're going to see economic data that's going to give us the opportunity to buy things at a discount as we vacillate. And so if for some reason we see rates go up again, even organically, even though the Fed hasn't done anything in 4 months, you know, that's going to be a buying opportunity on whatever stocks you think are growing. But a word to the wise, you want to buy things who are expanding in this environment. Target just blew out earnings. With some fancy financial earnings or financial management yesterday, but their same-store sales declined, and a lot of their profit centers are declining as well. And so that's not a company that you want to own long-term, even though the stock popped to $18. I'd be afraid of retailers at this stage of the cycle.
Okay. Jeffrey Small, Arbor Financial, thank you so much. Great to see you. Appreciate it.